Geopolitical shockwaves trigger historic market collapse. A localized conflict has escalated into a systemic threat, exposing the profound vulnerability of export-dependent economies to energy supply chain disruption. The 12.06% single-day plunge in South Korea's Kospi index represents not merely a market correction but a fundamental repricing of risk in an interconnected global economy.
This historic drop, surpassing the post-9/11 collapse, was precipitated by the effective closure of the Strait of Hormuz, a critical choke point for global oil shipments. The immediate, catastrophic impact on shipping and logistics firms, with stocks like Pan Ocean and TIM falling over 16%, underscores the market's acute sensitivity to energy logistics.
This event starkly contradicts the Kospi explosive 40% plus gain in early 2026, illustrating how geopolitical black swan events can instantly vaporize speculative gains and expose underlying structural frailties.
The Strait of Hormuz, Asia's economic Achilles heel. South Korea's near-total dependence on imported fossil fuels transforms a regional blockade into a national economic crisis. The strategic context for this meltdown is South Korea's extreme energy import dependency, with 98% of its fossil fuel needs sourced from abroad, primarily via the now-threatened Persian Gulf routes.
The status quo efficient, just-in-time global supply chains has been violently disrupted by Iran's retaliatory attacks on Gulf allies, including Qatar and the UAE. This has triggered a classic risk-off flight from assets tied to global trade, disproportionately impacting Korea's cable giants like Samsung and SK Hynix, whose complex, energy-intensive manufacturing processes are now under severe cost and logistical pressure.
The activation of the 20-minute circuit breaker after an 8% drop was a procedural response to a systemic failure, highlighting how automated safeguards are inadequate against fundamental geopolitical ruptures.
From energy shock to full-spectrum financial contagion, the market collapse reveals a cascading failure mechanism linking energy security, corporate profitability, and investor psychology. The deep dive analysis shows a precise transmission mechanism. The Strait of Hormuz closure immediately cripples shipping, which spikes global energy and freight costs, thereby crushing the margins of Korea's export-oriented manufacturing base.
This creates a reflexive sell-off in blue-chip equities, which triggers panic and broad-based liquidation, culminating in a historic two-day streak of losses exceeding 19%. The relative resilience of US indices like the S&P 500, which fell only about 1%, underscores the asymmetric risk borne by trade-dependent Asian economies.
Furthermore, the muted initial Wall Street reaction followed by delayed losses suggests a dangerous lag in risk perception, where localized conflict is initially discounted before its global ripple effects become undeniable, leading to volatile catch-up sell-offs.
A new paradigm of persistent volatility and strategic realignment. The event mandates a permanent recalibration of risk models to prioritize geopolitical energy security over pure financial metrics. The strategic verdict is that this meltdown is a harbinger of a new investment era defined by geopolitical premium on asset prices.
Future projections indicate sustained volatility for energy-importing nations, necessitating strategic next steps including aggressive diversification of energy sources and stockpiling. The diplomatic protests from Russia and China against the US-Israeli actions signal a broader geopolitical realignment that will further complicate trade flows.
For investors and policymakers, the critical path forward involves de-risking supply chains and recognizing that in a fragmented world, financial market stability is inextricably linked to energy corridor security. The opportunity lies in catalyzing investments in alternative energy and logistics resilience, while the paramount risk remains an escalation that permanently disrupts global maritime trade routes.